Hey everyone, welcome back to Corporate Decoder, the place where we slice through the corporate jargon to find the real stories behind the filings. And boy, do we have a packed report to unpack today. It's an annual shareholder report from AdvisorShares Trust, and it's loaded with more ETFs than a stock exchange. This is a certified shareholder report for registered investment companies. Think of it as an annual checkup for a bunch of different stock funds, all managed under one big umbrella called AdvisorShares Trust. We're looking at data up to June 30, 2020, 2020, 2020, 2025. So this gives us a peek at how these funds performed over the past year. AdvisorShares is an ETF sponsor, meaning they create and manage exchange-traded funds. ETFs are like baskets of stocks or bonds that trade on an exchange like regular stocks. They've got a whole bunch of these baskets, and this big report covers them all. Right off the bat, they show us what a hypothetical $10,000 investment would have cost in fees. This is super important because fees eat into your returns. For the AdvisorShares Dorsey Wright FER ETF, that cost was about $126, or 1.10% of that investment. Some of the other funds have lower costs, like the AdvisorShares Dorsey Wright FSM All Cap World ETF at $98 or 0.925%. It's good to compare these because even small differences in fees add up over time. For the AdvisorShares Dorsey Wright ADR ETF, they mention it finished the year ahead of its benchmark, which is the MSCI AF index. They talk about momentum strategies helping, with momentum up nearly 25% in the US, which is huge. But then they also mention the US dollar strengthening in the second half of 2024, which made things tricky for international investments, though they managed to profit from Argentina. The first half of 2025 was a different story, with international equities doing really well, but the fund lagged a bit because it wasn't as heavily invested in them. It's a reminder that markets are always shifting, and what works one year might not work the next. Now for the really juicy part, actual performance numbers. This table shows how a $10,000 investment would have grown over time. Look at the bottom line for June 2025, that $10,000 investment in the AdvisorShares Dorsey Wright ADR ETF is now worth over $22,000. That's more than doubling your money. Compare that to the benchmark, the MSCI AF index, which turned that same $10,000 into about $17,080. So the fund clearly beat its benchmark. This table summarizes the yearly returns for the AdvisorShares Dorsey Wright ADR ETF. The one-year return was 28.43%. That's way better than the MSCI AF index's 17.73% for the same period. Over 5 years, the fund returned 9.72% annually, while the index returned 1% of 8%, so the fund had some really strong periods. But over the longer haul, the index was a bit better. Over 10 years, it's 8.42% for the fund versus 6.51% for the index, so the fund did win out over that longer time frame. Here we get some key numbers. The total net assets for this fund are around $46.8 million. The advisory fees paid were about $211,000. They hold 37 different investments, and the portfolio turnover rate was 56%. Portfolio turnover means how often they buy and sell investments. A 56% turnover suggests they are actively managing the fund. This table shows what sectors the fund is invested in. Banks make up the biggest chunk at 19.7%, followed by internet at 17.3%. Money market funds are 10.6%, and telecommunications is 9.4%. It's interesting to see these sectors. Banks and the internet are pretty standard, but it's good to see the diversification. This is another fund from AdvisorShares. It aims for long-term growth and capital preservation. For the fiscal year ending June 30, 2025, it lagged its benchmark, the MSCI Asset Ali Index. They mention international equities did ramp up in early 2025, and the fund was underweight in international stocks, which hurt its performance relative to the benchmark. They did make some adjustments, adding an international developed low volatility ETF. Looking at the performance for this fund, that hypothetical $10,000 investment as of December 2019 is now worth about $17,198. The benchmark, the MSCI All Country World Index, turned that same $10,000 into about $17,700 into about $17,076. So the fund underperformed its benchmark, which aligns with their commentary, and end well about $17,000 into about $17,076. So the fund underperformed its benchmark, which aligns with their commentary. The one-year return for this fund was 6.32%, significantly less than the 16.7% return of the benchmark. Over 5 years, it's 9% for the fund and 13.65% for the index. It seems this fund has struggled to keep pace with its benchmark. This fund is much larger with over $82 million in net assets, but the advisory fees paid clock in at a hefty $605.84 times $7. That's quite a bit for a fund that's lagging its benchmark. The big stat here is the turnover rate 17%. That means they are buying and selling holdings very frequently, which can lead to higher trading costs and might not always be beneficial. This ETF focuses on US large cap core equity ETFs and aims for long-term capital appreciation. For the fiscal year ending June 30, 2025, it outperformed its benchmark, the S&P 500 index. They attribute this to stable momentum since August 2024, after a rough patch in August 2024, which saw higher drawdowns than the benchmark. They did add some defensive exposure to the S&P 500 low volatility ETF. Let's check the numbers. The $10,000 investment in this fund as of December 2019 is now worth about $20,603. The S&P 500 index turned that same $10,000 into $20,869. They said it outperformed, but the numbers show it slightly lagged its benchmark. The average annual total return for the fund is 8.69% for the fund compared to $69. They said it outperformed, but the numbers show it slightly lagged its benchmark. The average annual total return for the fund is 8.69% for 1 year versus $59. They said it outperformed, but the numbers show it slightly lagged its benchmark. The average annual total return for the fund is 8.69% for 1 year versus 15.164% for the index, so while they claim outperformance, the data here suggests otherwise. It's important to always look at the numbers yourself. This fund is the largest we've seen so far, with over $116 million in net assets. The advisory fees paid are also substantial at 855%, which is high but not as extreme as the previous fund. The portfolio composition is interesting, 99.5% in equity funds and 20 funds and 21% in money market funds. That's a very concentrated portfolio, which can lead to higher returns but also higher risk. This is a short ETF, meaning it's designed to profit when the market goes down. They say it finished the year ahead of its benchmark, the inverse of the S&P 500. Downside momentum helped them a lot. They mentioned shorts in smaller cap stocks performing well while large caps were dominant. The second half of 2024 saw outperformance largely because it sidestepped the decline seen in other short funds. However, the first half of 2024 saw outperformance largely because it sidestepped the decline seen in other short funds. However, the first half of 2025 saw some lagging performance as leadership changed. This is where things get wild for a short ETF performance chart. That $10,000 investment from July 2018 is now worth around $3,479. Meanwhile, the S&P 500 index over the same period turned $10,000 into over $24,000. This clearly shows the risk associated with inverse and short ETFs. The 1 year return is 4.78%, which sounds okay, but is way behind the S&P 500's 1516. Over 5 years, it's negative 14.05%. This fund has a strategy that works great in down markets but can lose a lot of money in up markets, which is what we've seen recently. Net assets are about $12.5 million. Advisory fees paid are around $37,340, but the big number here is the portfolio turnover rate, 29%. This means they are actively trading, which makes sense for a short strategy, but it also contributes to costs. The sector breakdown is eye-opening, with a lot of negative percentages reflecting the short positions. For example, semiconductors is at negative 11 with a lot of negative percentages reflecting the short positions. For example, semiconductors is at negative 11.1%. This is expected for a short fund, but it highlights the high risk nature. This ETF CWS had a good year, beating the S&P 500. They highlight a few key factors: the presidential election, geopolitical issues, and the Fed's interest rate policy. They note a stock market drop in February and March 2025 due to new tariff policies, but a rally followed when those tariffs were paused. Their focus on quality stocks helped them do well when the market got nervous. Checking the numbers, that hypothetical $10,000 investment from September 2016 is now worth over $29,000, beating the S&P 500's growth to about $29,290 by a hair. For the 1 year return, the fund has 13.24%, slightly behind the S&P 500, so it's a bit of a mixed bag there, but they are closing the gap, 16.64% for the S&P 500, so it's a bit of a mixed bag there, but they are closing the gap. This is a fairly large fund with over $92 million in net assets. The advisory fees are just over $900,000. The turnover rate is only 24%, which is quite low compared to some others, suggesting a more buy and hold strategy for their selected stocks. The sector breakdown shows a heavy focus on software at 18.3%, followed by healthcare products at 11.4% and pharmaceuticals at selected stocks. The sector breakdown shows a heavy focus on software at 18.3%, followed by healthcare products at 11.4% and pharmaceuticals at 8.8%. This shows a clear tilt towards growth and innovation. This ETF, GK, had another solid year, boosted by their focus on AI companies and digital consumer service firms. Top tech holdings like Nvidia, Broadcom, and Microsoft were standout performers. They also mention holding Bitcoin and gold as hedges against inflation, which is a unique strategy. Let's see how that strategy played out. The $10,000 investment from July 2021 is now worth about $15,253. The S&P 500 index turned that same investment into about $13,878, so the $8 from the fund, which is better than the S&P 500's 16.64%. So again, strong longer-term performance, but a bit of a lag in the most recent year dollar fund, which is better than the S&P 500's 16.64%. So again, strong longer-term performance, but a bit of a lag in the most recent year. This fund has about $25 million in net assets. The advisory fees are around $47,891. The turnover rate is 63%, which is moderate. The portfolio composition is heavily weighted towards internet at 17 sectors at 13% and software at 9.1%. This clearly shows their tech focus. This ETF, BEDZ, had a positive return but modestly trailed the S&P 500. They attribute this to the hotel and travel sector facing headwinds like higher costs and labour shortages. Leisure travel was strong, but business travel recovery was slower. They remain optimistic due to upcoming global events like the 2026 World Cup and the 2028 Olympics. The numbers showed that $10,000 investment from April 2021 is now worth $13,500. Turn that same amount into $13, meaning this fund underperformed its benchmark. The one-year return is 113% for the S&P 500. It's a tough sector, and it looks like that's reflected in the performance. This fund is quite small, with only about $2.6 million in net assets. Notably, the total advisory fees paid are zero. This is interesting. Perhaps they use a different structure or have a fee waiver. The portfolio is heavily concentrated in lodging at 25.3% and internet at 22.9%. This is a newer fund launched in February 2025. It achieved doubled the S&P 500's performance in its short time frame. They highlight drivers like urbanization, rising global temperatures, increasing cooling needs, and the growth of data centers. Retrofitting and upgrading systems for environmental standards also played a role. The performance table only covers a few months since its inception. The $10,000 investment from February 2025 grew to about $10,411 by June 2020. The S&P 500 for that same period only grew to about $9,321. So the fund massively outperformed in this short initial period. The annualized return since inception stands at a very strong 11.31% compared to 4.111% for the S&P 500. It's early days, but so far so good. This fund is very small with just over $1.1 million in net assets. The advisory fees paid are zero, which is noteworthy, same as the hotel ETF. The portfolio is concentrated in building materials at 15.4%. This shows pure focus on the industrial sector. This fund, sure, had its performance impacted by global market volatility, including election uncertainty, interest rate changes, and tariffs. Overweight positions in financial and industrial stocks helped, but underperformance in energy and consumer discretionary sectors hurt. They note that mid and small cap stocks underperformed, which also affected their equal weight strategy. Looking ahead, they're cautiously optimistic about tax policies and corporate share buybacks. Let's look at the numbers. The $10,000 investment from June 2015 is now worth about $46,955. The benchmark, the Russell 3000 index, grew that same investment to about $33,082. That same investment to about $33,022. So this fund significantly outperformed its benchmark. The one-year return is 5.34% for the fund, much lower than the S&P 500's 15.64% for the fund, much lower than the S&P 500's 15.64% for the fund, much lower than the S&P 500's 15.39% for the fund versus 16.64% for the S&P 500. This fund has a good long-term track record but sees fluctuations. Net assets are around $46.9 million. Advisory fees paid are about $2,170. The turnover rate is a high 23.1%, indicating a lot of trading. The portfolio composition is spread across many sectors, with retail at 10.9% and diversified financial service at 9%. This ETF MSO-esque fix seeks 2 times the daily return of the AdvisorShares pure US cannabis ETF posted negative returns. They blame this on regulatory uncertainty and competition in the US cannabis sector. It's a leveraged ETF, meaning it employs derivatives to amplify returns, which also amplifies losses. This chart is almost painful to look at for a leveraged ETF. That $10,000 investment from August 2022 is now worth just $56. Yes, you heard that right, $56. The S&P 500 over the same period turned 10,000 into 15,006%. This illustrates the extreme risk of leveraged ETFs, especially in volatile sectors. Net assets are just over $10 million. Advisory fees paid are around $124,812. The turnover rate is reported as 0%, which is unusual for a leveraged ETF and likely relates to how they manage their derivatives positions rather than traditional stock trading. The portfolio composition is also odd, with 96.9% in other assets in excess of liabilities and only 3.1% in money market funds. This structure is typical for leveraged ETFs that use derivatives. This ETF YOLO also saw negative returns due to political uncertainty and stalled progress on cannabis regulations. Like MSOS, hit hard by the sector's challenges. They are optimistic about the long-term outlook though, especially with potential federal reforms. Let's look at the numbers. That $10,000 investment from April 2019 is now worth a mere $83. The S&P 500 over the same period would have grown that to over $15,000. The one-year return is a shocking negative 43.36%. Over 5 years, it's negative 27.48% annually. And since inception, it's negative 32.38% 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 annually. This sector has been incredibly difficult for investors. Net assets are about $24.6 million. The advisory fees paid are 0, which is interesting, similar to the hotel and HVAC ETFs. The turnover is 30%. The portfolio composition is heavily weighted towards pharmaceuticals at 32.8%. This ETF, MSOS, also experienced significant declines. They blamed the drops on price compression, competition, and stalled federal reform. The key catalyst they're watching is potential rescheduling of cannabis to Schedule 3 in the US, which could ease banking and capital restrictions. This chart, starting in September 2020, shows a $10,000 investment plummeting to just $9,566. The S&P 500 would have grown that to over $16,000. The one-year return is a disastrous negative 67.40%. Since inception, it's negative 38.51% annually. This is a sector that has seen massive investor enthusiasm followed by a brutal reality check. This is a larger cannabis ETF with over $314 million in net assets. The advisory fees are a hefty $3.45 million. The turnover is 0%, which, like MSOX, suggests a derivative-based strategy rather than active stock picking. The portfolio composition is equally stark, 83.1% in other assets in excess of liabilities, suggesting a heavy reliance on derivatives to achieve its leveraged exposure. This ETF QPX outperformed the S&P 500 over the past year. Their strategy involves a consistent overweight in technology with an average allocation to SEC of around 40%. They also maintain significant exposure to gold and consumer discretionary. They had a brief tactical shift in April 2025 to reduce risk. Let's check the numbers. The $10,000 investment from December 2020 has grown to about $15,491. The S&P 500 index grew that to $16,120. So it underperformed the S&P 500 on a relative basis. The one-year return is 14.65%. While they claim outperformance, the direct numbers show it lagging the benchmark. Net assets are about $25.3 million. Advisory fees paid are $235,766. The turnover is a very high 334%, meaning they are very active traders. The portfolio is concentrated in equity funds at 80.4% and commodity funds at 17.4%, specifically gold. This ETF, HD, seeks to profit from declining equity markets. For the fiscal year ending June 30, 2025, its performance was negative 11.64%, while the S&P 500 was up 15. Maximum damage in equity markets. The chart starting from June 2015 shows a $10,000 investment shrinking to about $342. The S&P 500 would have turned that into over $35,000. The one-year return is a very negative 11.64%. Over 5 years, it's negative 16.25% annually. This is a fund designed to lose money in a bull market, and it certainly did that. Net assets are around $45.5 million. Advisory fees paid are a substantial $829,840. The turnover rate is a sky-high 624%, indicating extreme trading activity. The portfolio composition is mostly negative percentages in various sectors, reflecting short positions and a massive 146.4% in money market funds, which is how they hold cash for shorting. AdvisorShares Restaurant ETF, this ETF, ETZ, delivered a strong positive return and outperformed the S&P 500. They highlight the restaurant industry's resilience despite inflation and rising costs, with fast casual and quick service restaurants benefiting from value and convenience. Operators are using digital ordering and operational efficiencies to cope. The chart starting April 2021 shows a $10,000 investment growing to $12,728. The S&P 500 grew that same investment to $13,878. So this fund slightly underperformed its benchmark in this period. The one-year return is 24.36% for the fund, beating the S&P 500's 15.16%. So while they slightly underperformed the historical chart, their one-year performance is actually quite strong and beat the S&P 500's 15.16%. So while they slightly underperformed the historical chart, their one-year performance is actually quite strong and beat the S&P 500's 15.116%. So while they slightly underperformed the historical chart, their one-year performance is actually quite strong and beat the S&P 500's 15.1%. This fund is relatively small with just under $3.7 million in net assets. Notably, the advisory fees paid are zero, similar to the hotel and HVAC ETFs. The turnover rate is 115%, meaning active management. The portfolio is heavily concentrated in retail at 75.4%. This ETF, Vigor, invests globally with target weights in equity and fixed income, and it also writes covered calls and buys protective puts to manage risk. They mention a volatility-based rebalance in July 2024 and again in March 2025, adding gold and increasing emerging market equity exposure. Their option overlay strategy helped reduce portfolio standard deviation during market volatility. The $10,000 investment from June 2015 has grown to about $25,923. The benchmark, the MSCI Country World Index, grew that to about $22,450. So the fund significantly outperformed its benchmark here. The one-year return is 11.22% for the fund versus 13.65% for the index. So a strong long-term showing, but some recent underperformance. And over on Didvommans and OnCrew, 5 years, it's 8.48% for the fund versus 13.65% for the index. So a strong long-term showing, but some recent underperformance. Net assets are about $65.9 million. The advisory fees are $541,721. The turnover rate is a very low 15%, indicating a more passive approach to their allocation strategy. The portfolio composition shows a large portion in equity funds at 69.3% and debt funds at 27.1%. This ETF, VICE, delivered a positive return and outperformed the S&P 500. They attribute this to the defensive characteristics of the VICE sector, including alcohol, tobacco, and gaming. Gambling and gaming segments saw demand from online platforms and legalized sports betting. Tobacco offsets cigarette declines with alternative products. They expect continued stability and growth. Looking at the chart from December 2017, that $10,000 investment is now worth about $33,732. The S&P 500 index grew that same investment to about $24,918. So this fund significantly outperformed the S&P 500. The one-year return is 27.4% for the fund, which is much better than the S&P 500. The long-year return is 27.4% for the fund, which is much better than the S&P 500. The one-year return is 24% for the S&P 500. So strong recent performance, but the longer term lags. The benchmark 100 index grew that same investment 4% for the fund, which is much better than the S&P 500. The one-year return is 20.79% for the fund versus 16.64% for the S&P 500. The one-year return is 20.74% for the fund, which is much better than the S&P 500's 15.1 fund. The fund a longer term lags the benchmark. This is another smaller fund with $73 million in net assets. Advisory fees paid are zero, consistent with some other ETFs in this filing. The turnover rate is 162%, showing active management. The sector breakdown is very interesting, with agriculture at 25.8%, followed by software at 12.3%. and internet at 12.4%. That's a unique concentration in agriculture for a Vice ETF. Now, let's quickly touch on the operational side. The company has a code of ethics for its top officers. No amendments were made to it during this period, and no waivers were granted. This is standard procedure, basically saying everything is operating as expected from an ethical standpoint. Their auditors, Tate, Weller and Baker LL, billed them for services. The audit fees for 2025 were about $302,810, and for tax services, it was $54,000. These numbers seem reasonable for a trust managing multiple funds with significant assets. The audit committee pre-approves all these fees, which is a good governance practice. The audit committee members are Elizabeth Piper Bark and William G. McVeigh. They are independent trustees, which is a crucial role in overseeing financial reporting and internal controls. The schedule of investments is included in the financial statements. This is where you'd find the detailed breakdown of every single holding in each fund, but we already looked at the sector breakdowns, and those are usually the most telling. This points to the full financial statements, which we've been pulling numbers from. This is the auditor's stamp of approval. Tate, Weller and Baker confirms that the financial statements present fairly in all material respects, the financial position and results of operations. This is standard for an audit report, and the fact they've been auditing the trust since 2009 suggests a long-standing relationship. This section details the board's annual review of the advisory contracts. They looked at the nature and quality of services, fund performance, cost, profitability, and potential economies of scale. They seem satisfied with the arrangements, approving the renewals. This is a key governance step to ensure the funds are managed in the best interest of shareholders. Here we find details on quarterly holdings, proxy voting, and premium dose count information. These are readily available on the SEC website and the fund's site, offering transparency for investors. This is where the really technical stuff lives. They cover accounting policies, investment valuation, derivative instruments, and tax information. For example, the MS-OS daily leveraged ETF and pure cannabis ETF usage of derivative instruments, and their impact on the financial statements is detailed here. The disclosure about the Q Dynamic Growth ETF incurring a tax liability due to non-qualifying gross income exceeding the limit is a significant event, though the advisor is reimbursing them. So what's the story here? AdvisorShares offers a wide variety of specialized ETFs, from broad market trackers like the Dorsey Wright funds to highly niche and risky ones like the MSO's leveraged ETF and the Psychedelics ETF. Performance varies wildly. Some funds like the Dorsey Wright ADR ETF and the Vice ETF showed strong outperformance this past year, even against the S&P 500. Others, particularly those in challenging sectors like cannabis or those using leveraged strategies, and seeing significant losses. It's a clear reminder that past performance is not a guarantee of future results, and high returns often come with high risk. As seen with the short and leveraged ETFs, the expense ratios are generally reasonable, with some notable zero advisory fees. On certain ETFs, the active management and shorting strategies in funds like DWH and HDG are inherently risky, and the financial results clearly show that, losing substantial amounts of money in an overall rising market. On the other hand, funds focused on specific sectors like HVAR funds means investors need to do their homework. And alright, that's our deep dive into AdvisorShares Trust's annual report. What do you think about these funds and their performance? Let me know in the comments below if you found this breakdown helpful. Smash that like button and don't forget to subscribe to Corporate Decoder for more insights into these complex financial filings. Also, join our Discord community linked in the description for more in-depth discussions and to connect with other corporate finance enthusiasts. Thanks for watching.